Noon, Nana, Oliver.
Yes.
Yes, sir.
Good, because that is a very small key point, but if you don't understand this, this will impact your ans whole answers, and you will get less marks, right? So the aging method will bring the balance of the allowance tend to negate the amount as determined by the aging schedule. So it will tell you total balance. So you need to find the adjustment, and this is going to be the entry. Entry is the same, expense to allowance for uncollectible accounts. Simple. All right. So when you post it, total balance is here. That is the adjustment. So your account receivable based on aging will be shown on balance sheet as net of 98, which is 10,10930. All right. So let's just digest that. There are two methods. There are two methods that we use to calculate the allowance for uncollectible. One is percentage of sale method, and one is aging method, aging of receivable method. Percentage of sales method is tell you the adjustment. It is based on the in the income statement approach, and you multiply this with the sales, and you find out the adjustment in the uncollectible accounts. While the aging of receivable based on balance sheet, and it tells you the total balance of account allowance for uncollectible. It means adjustment is a plug figure. All right. So let's take a break, and then we start some examples in which we evaluate collectibility using allowance for uncollectible accounts. Okay. Let's take a 10 minutes break. Okay, class, welcome back after the break. We talked about, before break, we talked about the percentage of sale method and aging of receivable method. Okay, let's move forward to understand the collectibility using allowance for uncollectible accounts. So let's do that. First of all, we make a smart move. We in advance include the allowance for uncollectible. Now, what happens if the uncollectible actually happens? When actually happens, we name this phenomena writing off uncollectible accounts. All right. First, we create allowance for uncollectible, and then we write off, which means if we see that these accounts or these amounts are not actually uncollectible, then how we are going to deal with? We name that writing off the uncollectible accounts. So assume that we have illustration here. Assume that at the beginning of fiscal year 2013, the Apple Corporation has these accounts. We have RS 9 million, we have TM 3 million, and we have other receivable 11016, right? So total is 11028, and we have 98 allowance for uncollectible. All right. Now, if we minus uncollectible, so your total net receivable is 10930. So remember this in your mind. 10930 is your account receivable that are shown on balance sheet. So balance sheet writing the account receivable as 11028 net of 98,10930. All right, 10,930. So now, early in fiscal 2013, yes, 2013, Apple credit department determines that Apple cannot collect from RS. So what is the amount in RS? 9 million. So 9 million is not going to be received. All right. So what will happen? If 9 million is not going to receive, account receivable of 9 million is not going to be received. So it means your asset decreases 9 million. All right. So how we are going to write off this? We charge allowance for uncollectible to simple account receivable. So did you see any expense here? There is no expense account here. Why? Because in advance, when we created the allowance, we made the entry uncollectible expense 88 to allowance uncollectible account receivable 88. Now this already gone to income statement. Now any actual thing happen will be only charged to this amount. So 9 million is not actually received. What will be the entry? Decrease in allowance means debit. Why? Because this is contra account for account receivable. Increase in account receivable, debit. So increase in allowance mean credit. Decrease in account receivable, credit. So decrease in allowance, debit. So allowance 9 to account receivable 9. So it means anything that happened will be actually happened, writing off will be charged to account receivable, so that our profit is not going to be disturbed. We already charge 88 million to income statement. It is not going to be disturbed. So what is the entry? Allowance for uncollectible to accounts receivable. So you see here uncollectible. If you post those entry here, all right, this account is now closed, write off, and you charge this line here. So now what happened here? Now your new account receivable is 11019 and net of 89. So your total amount on balance sheet is not disturbed, 10930. So recall, I told you to remember this amount. That is the beauty of having allowance. So your prediction, your estimation, your planning is not disturbed. So if you compare here, before writing off and after writing off, this amount is the same. Before writing off, it is here. Before writing off, we have 9311016. So we have total account receivable 11028, and we have allowance 98. So net of 10930. So after we charging the actual account receivable, the amount is again the same. Net account receivable is not disturbed. All right. So this is the beauty of planning, making reserve or allowance for uncollectible. All right. So you see, uncollectible is before write-off and after write-off, it is not disturbed. Right? It is not disturbed. Only allowance decrease and account receivable decrease. The net amount that is shown on balance sheet is the same. All right. So remember, the percentage of sales method tells you the adjustment that need to be charged to income statement. So this adjustment will directly go to income statement, while aging of the account receivable method tells you the balance. It means you find out adjustment and then you make entry to the income statement. All right. So that is the difference. We already discussed that. Now, if you understand all this stuff, then let's do this illustration. So on November 30, High Peaks party planners had a 34,000 balance in account receivable, 30,000 in credit balance of accounts, allowance for uncollectible accounts. You highlight the balances. During December, High Peaks party planners credit sales are 159,000. December collection on accounts were 130,000. Write-offs of uncollectible are 2,700. That is the actual writing off. And they estimated that 1% of sales are uncollectible. So number one, generalize the entries of sales, collections, and writing off and uncollectible expenses by allowance method during December. So our method, allowance method, is percentage of sales. So question didn't mention the aging of account receivable. They didn't give us the table of aging as well. So they tell us 1% of credit sales. Credit sales is 159,000. All right. And then second is show how High Peaks planner will report account receivable and net sales on the account receivable balance sheet. So number one, during December, the High Peaks party planners credit sales are, so what is the entry? Account receivable to sales, 159,000. All right. And then they collected 130,000. So cash to account receivable, simple, right? And now writing off uncollectible, total 2,700. So before, what is the entry for writing off? Allowance to account receivable. Allowance to account receivable. All right. When we are writing off, we are not charging it to any expense. Why? Because expense already occurred. How? Here. 159,000 uncollectible, 1% is credit of sales uncollectible. So 1% of credit sales 159,000 is 1,590. So what would be the entry when you create the allowance? Uncollectible expense